In this week's episode of the Stockscores Market Minutes, well, is the crash over? Last week I told you what to look for. This week I will tell you what happened, and then we'll figure out where the market is likely to go. So last week I explained how stock market bottoms are typically made. And just as a quick recap, we look for downward trend lines to be broken from rising bottoms. Lots of times you'll have little moves up within the downward trend. We had one of those this week. But what's important is that they break the downward trend line. We need to see that break of a downward trend line from a rising bottom. Almost all bottoms are made that way. So if we look at the charts this week, we can take what we learned last week, and I recommend you watch last week's video if you have not already, because that's the important foundation lesson for how to pick market bottoms when you've got a stock market crash. So let's take a look first at the daily chart of the SPY. This is the ETF that represents the S&P 500. And here you can see that this week we had a little rally right here. And then at the end of the week, we started to roll over. Now let me explain why that happened. Remember last week I talked about drawing your trend line across tops. So there's your downward trend line. We were oversold, which means emotion had pushed prices too low. When you get oversold, you almost always come back up to the trend line, which is exactly what happened. On Tuesday, we basically hit that downward trend line. But what I want everyone to notice is that that little move up to the downward trend line came from a new low. There was no rising bottom. And that's why when you hit the downward trend line, you are likely to get stuck there, roll over, and go lower. So if you take that lesson to heart, then you realize that that move up on Tuesday into the downward trend line was likely going to fail, that it was likely going to result in a pullback. And that's what we had Wednesday, Thursday, Friday. You can see again on the daily chart, we moved down. We actually hit new lows on Friday. And we did a nice job of coming back into the end of the day. You can see this is the low of the day right here. And this is where the market closed. We opened there. And so that's good. And volume picked up a little bit as well. So we still don't have that emotional exhaustion where there's lots of volume, the market panics, and then it reverses in a single day. We had some weakness Friday morning. We came back to close a little closer to the open, but still off and down. And we didn't have huge volume. So I don't think we've had the exhaustion of the downward trend. I think we could still see more weakness. And what's most important is we still have not broken downward trend lines from rising bottoms. Now, of course, we can look for these things in different time frames. You know, what a day trader looks at is very different from what an investor looks at. When I show the daily chart of the SPY, really that's appropriate for what we call a position trader. That's someone that holds stocks for a couple weeks, couple months. If you're a long-term investor or longer-term trader, then you're going to look at the 3-year weekly chart. So let's take a look at that one now. This is the 3-year weekly chart of the S&P ETF, SPY, and you can see that we are still in a downward trend. We are oversold because we're far below the downward trend line. And that means there's a good chance that in the weeks ahead, we either go sideways to come back to it or up. But don't fool yourself. It can still go down a lot farther oversold until it does that. And so what we need to do then is look at the shorter term time frame to try to see when those patterns of breaking a downward trend line from a rising bottom are unfolding. So I'm going to look here at a 1 month, 60-minute chart. All right, you can see right here in the upper left. What I did is I clicked on 1 month, 1M, and I clicked on 60M, which is 60-minute, and that gives me this 30-day, 60-minute chart. All right, who's in control, buyers or sellers? To answer that question, you look to see if there's falling tops or rising bottoms. Obviously, there's falling tops. Draw a line across those. That's your downward trend line. When you get too far below the downward trend line, you tend to come back up to it. That's just your typical cycle. So even on Friday afternoon, we were a little too far low. The market's starting to come back up. We may get back up to that trend line and get stuck early next week. But does that mean the crash is over? No, because what we have to have is the build of a rising bottom and then a break of that downward trend line. Now keep in mind, this is a 30-day, 60-minute chart. And so if we can build a rising bottom, break this downward trend line, that's fine for a short-term signal that there's a bottom, maybe appropriate for a day trader or a swing trader to take advantage of. But for the longer-term trader, you go to, say, the 1-year daily chart. And there we see that we got all these downward trend lines that need to be broken. The steepest one is only being flirted with on Tuesday, but we still haven't broken it. And so if we can build a rising bottom and then break that one, okay, that's great, but then what's our next stop? It's going to be this downward trend line. And if we can pull back, build a rising bottom, and then break that one, then we still need to break this one. So there's a lot of work for this market to do before we can give the all clear stock market crashes overcall. We may see opportunities as buyers if we're in the short term, day trading, swing trading, but for the long-term investor, I think you still have to be very cautious. Even as a day trader, you have to be cautious because we still have not managed to break any downward trend lines from rising bottoms. And again, I want to stress, I gave a whole lesson on this last week. Go to the YouTube channel for Stockscores and just watch the last video. All right, so let's talk now about the Canadian market. Actually, first, let's take a look at the Nasdaq 100. It's very similar. QQQ is the symbol there. I'll talk a little bit about how to make money from this weak market as well in just a moment. But here you can see downward trend line is intact, and then you've got these others. We have not been able to build a rising bottom, break the downward trend line, so the sellers are in control. Therefore, you want to be cautious. But how do you make money from that if you are maybe a shorter term trader? The beauty of these ETFs that are out these days is that you can profit from a market correcting, from a market crashing. And there's two ways to do that. You can buy volatility, a volatility ETF. These go up when the volatility of the market, or should I say the expected volatility of the market, is increasing. So something like UVXY is a leveraged inverse ETF on the VIX, which is the volatility index. And as a day trader, when there's sell-offs in the market, this is a place to trade. Look at this. This is a 5-day, 5-minute chart. We trade this a lot in active live. So here you had a break from a rising bottom, buy it at $15.40. By the following morning, it's $18. So you can swing trade that using this concept of breaking trends from rising bottoms for a buy signal. Here's another one. Downward trend, builds a rising bottom, breaks the downward trend line, has a nice little run for the day trader to take advantage of. Now, let's go back to the other way to take advantage of weakness in the market. There are inverse ETFs. So this is triple leveraged on the Nasdaq 100. It goes up as 3 times as fast as the Nasdaq 100 goes down. So you can see here, pullback, break of the pullback, rising bottom, break up from a rising bottom at 42. That was 6 weeks ago. Now it's at 58. That's a way to profit from a market that is crashing. Again, you can do this intraday as well. Just go to, the 5-day chart, 5-minute, and watch for those signals. Here's the sellers are in control. You break the seller's control, you build a rising bottom, and you break up from a rising bottom. Day trader, swing trader can buy that and enjoy the move higher, while most people are suffering from a stock market crash. All right, now I want to talk a little bit about the Canadian market, which looks a little different because we have that heavy emphasis of energy stocks in Canada. So if we go to the 3-year weekly chart, you will see here that it's not as bad as the US markets because it's got that commodity base. So you're basically in this sideways range. We're oscillating around in it. We may see the bounce back a little bit in the short term as we are at support. So I would give this a neutral rating. I don't think it's great, but it's not super negative yet. If we start to break down through that 30 level, I'd get a little bit more concerned. Now in the short-term chart, and again, we can go to an intraday chart. I clicked on 1 month, and you can see here, we still have falling tops. Sellers are in control. We are building a rising bottom right here. And so if we can break this downward trend line from the rising bottom, we may get that bounce back rally in the Canadian market. So watch for that next week. For now, no buy signal, but we could get a short-term signal to buy, just as a, not really a day trade, but more of a swing trade where you hold it for a few days. That could come next week. All right, let's take a look at some of the commodities now. So the leading commodity, of course, has been oil. And here is the oil chart. You can see it's building what we call an ascending triangle pattern. What that means is you have rising bottoms. That's a sign of optimism. And you have a line of resistance here. That's the upper boundary of what the buyers are willing to pay. And so if you get a breakout through resistance from optimism, from low volatility, which is what we have building right now, if we get a breakout from that, then this is going higher. So watch for that breakout on oil. And if that happens, then you'll get opportunity in the energy stock. So keep an eye out for that. We've got great upward momentum long term, but in the last 3 months, we've been stuck in this sideways range as the market looks to sort of consolidate the gains that it's made. Now GLD is gold, and it is again an ETF that you can trade. I think they call these ETNs. There's the downward trend line. We broke that on Thursday, but no rising bottom. So the chance of that leading into a strong upward trend is not good enough. It's the first step in a trend reversal. It's good to have this, but we still need to hit a little pullback, build of a rising bottom, break up from a rising bottom. Then you've got a possible signal to short-term trade the gold sector. We made a good step this week, but I'm not ready to be, waving my gold flag saying it's time to buy gold or gold stocks yet. Again, a little improvement this week, but there's still work to be done. All right, how about some of the cryptocurrencies? They've been suffering of late, and we've talked about this many times in recent months. This is a sector that is in the control of the sellers. And so here is GBTC, and you can see that we broke down through support a while ago. We've been first breaking the upward trend line there, then breaking down from a falling top there. So those are your sell signals. And we are still in the control of the sellers. There's no rising bottoms, therefore avoid crypto right now. US dollar interest rates is what we're going to finish up with here. So let's take a look at UUP, which represents the US dollar. And you can see it pulled back a little bit. I talked about that likely happening last week. Why? Because when price runs away from trend lines, it likes to come back to the trend line. And you're seeing that on the US dollar this week. The US dollar suffered. And finally, we're going to take a look at what I use as a proxy for interest rates. This is the inverse ETF on the 20-year treasuries. So if bond prices are falling, interest rates are rising. This is an inverse of the bond market. So if the bond market is moving up, this goes down. If the bond market is moving down, this goes up. It's all backwards, right? Basically, if this is going up, interest rates are going up. Well, remember last week I talked about how the market was a little overextended on interest rates and that I expected we'd see a little bit of a pullback. Simple principles, and I explained these last week, but when you run away from trend lines, you're likely to come back. We ran away, we're likely to come back. And that's exactly what we did in this last week. Now we're at the trend line. So the question is, are we going to break down through the trend line from a falling top, which is built, or are we going to bounce off of it? Watch for that next week. That's your critical signal as to whether the market believes interest rates have gone up enough, or do they need to go up more? And that's going to have a big effect on the market. If interest rates resume the upward trend, then I think that's inflation concerns, rising interest rate concerns. That's going to hurt the stock market. So this is a really important chart to watch, TBT. It'll give you a lot of insight into not only where the bond market and interest rates are going, if you want to borrow money, but also it's really important right now for where the stock market is likely to go. Well, I hope you've enjoyed this overview of the markets. I know there's a lot of turmoil out there, and I'd like to give you some visibility on where things are likely to go. General basic conclusion is that the weakness is probably not yet over. We don't yet have a signal that it is over, so be cautious. Trade some of those inverse products, those volatility products. You can make money from this kind of turmoil using those. Hope you've enjoyed it. If so, leave a comment where you think the market is likely to go. Did you like the video? Well, click on that like button. It helps broaden the subscribers to this channel, and I appreciate that. Hope you've enjoyed it, and trade well.